FBAR penalties start with one big question. Was the failure non-willful or willful? Non-willful is basically a mistake. Didn't know, overlooked it, or misunderstood the rule. Willful means you knew, or were reckless about it, and didn't file anyway. On the EA exam, they love testing that willful is the nuclear category because the penalty can scale with the account balance. Non-willful civil penalties can be over $10,000 per year, adjusted for inflation. The exam takeaway is simple. Even oops can be expensive. And it's per violation, which often tracks by year. So if you miss multiple years, the exposure stacks. Don't overcomplicate it. If it's non-willful, think a flattish dollar penalty, not a percentage of the account. Willful is where the math gets scary. The civil penalty can be the greater of $100,000 or 50% of the account balance per year for up to 6 years. Read that again. 50% per year. On the EA exam, when you see willful, your brain should immediately jump to percentage penalty and multiple years, because that's how you get to life-changing numbers fast. Now add criminal exposure. Willful FBAR violations can also bring criminal penalties. Think up to a $250,000 fine and up to 5 years in prison. For exam purposes, you don't need to memorize every nuance of prosecution. You do need to recognize the pairing. Willful can mean civil penalties plus criminal risk. Non-willful is typically civil only, unless other facts change the story. A real-world example shows how this plays out. In United States versus Kahn, the taxpayer had over $8 million in Swiss accounts and didn't report them on the FBAR. The government treated it as willful and assessed about $4 million, roughly 50% of the aggregate balances. Even after he died, the government pursued the estate, and the penalty was upheld. Exam tip: willful penalties can follow the money, even into an estate. The most common FBAR mistake is painfully simple: not filing at all. And remember, FBAR is triggered by the maximum aggregate value hitting $10,000 at any time during the year, even if the account ends the year at zero, like Jose transferring $19,000 briefly to Mexico for a home project. That one spike creates a filing requirement, so the practical risk is missing the filing, then arguing later about willfulness. Aisha is a U.S. citizen. Her father, Rohan, a citizen of India, owned a 75% interest in an Indian corporation. During the year, Rohan dies, and his 75% ownership stake passes directly to Aisha. Besides her regular income tax reporting, which special form is Aisha required to file to report her newly acquired ownership in this foreign corporation? The choices include a non-resident return, FBAR, Form 5471, and Form 8938. Think about it. The correct answer is Form 5471. That's the key form for U.S. persons who acquire enough ownership in a foreign corporation to meet a filing category. FBAR is tempting because it's foreign, but FBAR is about foreign financial accounts, not corporate stock ownership. Form 8938 can report certain foreign assets, but Form 5471 is the specific corporate ownership reporting form tied to the income tax return. Which form requires U.S. persons to report various types of foreign assets, not just bank accounts? The options include Form 8938, Schedule B, Form 8300, and the FBAR. Think about what covers broader foreign financial assets, not just accounts. The correct answer is Form 8938. It's the statement of specified foreign financial assets, and it can include foreign accounts plus other foreign assets like certain securities or interests. FBAR is narrower. It focuses on foreign financial accounts. Schedule B is where you answer foreign account questions on the tax return, but it's not the main foreign asset reporting form.